Hi everyone, welcome to this month's Financial Markets Update. Well, it may prove to be another difficult month for financial markets, and we saw both equity and bond markets weaker over the course of the month. When we sort of unpack that a little bit from our perspective, we think that the real driver of that was, the ongoing rise in inflationary expectations, which continues to permeate on a global basis, as well as the changing stance from central banks. Central banks are becoming a lot more aggressive in regards to their monetary policy framework, and that is really now starting to play out, whether it be in developed or emerging market economies. Domestically, we saw the RBA increase rates by 0.25% in May, and they followed that up with a 0.5% rise in early June. So the cash rate here now is at 85 basis points, so a significant uptick from its low, and we continue to expect that cash rates are going to move higher over the next 6 to 12 months, given the fact that inflationary expectations are well north of central bank target bands. Domestically, we see the cash rate somewhere in the range of 2.25% to 2.5% by June of next year, and we think that inflation is likely to peak north of 6% here domestically, and that is going to continue to be a challenge for the policymakers, as I said, over the next 6 to 12 months. When we look at the drivers of inflation more broadly, and we think central banks are in a little bit of a rock and hard place at the moment, we think some of those drivers are simply really being driven by macro events and geopolitical events, as opposed to just domestic demand that's running hot. And we think about that in the context of commodity markets. We're seeing the war in Ukraine is having a significant negative impact on the supply of agricultural goods into global markets. Ukraine is a significant supplier of wheat, as an example, and that's been constrained right across the globe, as well as obviously the restrictions that are being placed on Russian oil and gas, and that's also having implications for Western Europe, which is a significant user historically of Russian oil and gas, as they look to obviously pivot away from that. And that's having a big impact, as I said, on gas, particularly in the context of the supply side. Equally, when we look at what's occurring in China and the COVID zero policy, that's also having implications for industrial manufacturing on a global basis and the supply of goods into the global economy. Rolling lockdowns, we've seen a significant negative impact in terms of the growth outlook for China. And that's highlighting, as I said, just the challenges associated with the supply of goods into the global economy and the lack of supply, and that's driving up supply prices simply because the demand still remains elevated on that front. And the third one really is labour mobility, which continues to remain relatively constrained and certainly nowhere near as flexible as it was pre-COVID, and we're seeing that across multiple sectors of the economy, and that's obviously resulting in wages moving higher in parts of the economy, both domestically as well as on a global basis, and again that's flowing through into inflationary expectations. So those challenges we feel aren't necessarily going to be contained directly by higher rates, and the challenges that we see for central banks in the medium term is how do they contain inflationary expectations, or at least start to moderate it without tipping individual economies into recession. And that from our perspective is probably the biggest issue facing policymakers over the next 6 to 12 months, as they, as I said, look to try and contain inflation. They look to try and do that in an environment where there are a lot of exogenous and macro factors that aren't necessarily in their direct control, without, as I said, crimping their domestic economies. So when we think about that in the context of financial markets, it does make for a pretty difficult backdrop in the short to medium term in our view. As we translate that into the way that we think about positioning portfolios, our perspective is very much one around how do we mitigate that downside risk across portfolios, understanding that clearly both growth and defensive assets can generate negative returns, can be under pressure over that period. But as I said, maintaining a flexible approach to the way that we look at our individual portfolios in order for us to be able to potentially capture some of the opportunities that will clearly come through, and the ability for us to better manage risk. And we think about then the context of individual strategies. We're continuing to remain underweight our fixed income, but within our fixed income allocations, look towards more direct exposures in regards to individual investments, thinking about real assets and the protection that we can get through higher inflation coming through the system, or what that means for those real assets, and also increasing our allocation to alternatives, as I said, to better balance and manage our risks right across our portfolios on that basis. Through our direct equities, looking at, as I said, the cyclical side of that and how we can best leverage off, as I said, those higher commodity prices that are coming through the system, particularly those commodities that are in demand on both a domestic and a global level. So, clearly a very difficult and challenging environment. We're seeing a material shift now in the policy framework as it relates to central banks, and that's going to, as I said, be ongoing over the next 6 to 12 months, at least in our view, as banks look to normalise cash rates. They're doing that on the backdrop of trying to, as I said, moderate inflation, but we think that moderation of inflation is going to be challenging given there are a lot of macro factors at play that simply will be exogenous to central bank policy, at least in the short to medium term, in our view. As always, if you have any queries or concerns about the portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks, and bye for now.